Thank you for watching this preview video at xm.com. We'll be discussing the UK economy, upcoming data, and the potential reaction in the pound. I'm Maria Pachurdiz, and joining me is Senior Investment Analyst Haralambos Pissouros. So Haralambos, last week, the Bank of England decided to keep interest rates unchanged. Can you tell us about the current state of inflation in the UK and how upcoming data might impact the BoE's next moves?
Hello, Maria. Now, inflation in the UK is more than triple the Bank of England's 2% objective, both in headline and core terms. On its own, this argues that the Bank of England should have continued raising interest rates, but that's not that simple. Last week, as we already mentioned, the Bank of England kept interest rates unchanged, and officials noted that some further tightening may be required if there is evidence of more inflation pressures. However, the market was not convinced. Investors continue to see only a 15% probability for another quarter-point hike by February and around 70 basis points worth of rate reductions by the end of the year. This may be due to the weak economic performance of the UK. With the bank estimating flat economic growth for the third quarter this year, Friday's official GDP data for the quarter may attract special attention. Expectations are for the economy to have shrunk 0.1% quarter over quarter after growing 0.2% in the second quarter. And a contraction is supported by the UK composite PMI, which stood below 50 for most of the quarter, actually in August and September. Having said all that though, given that Governor Bailey said after last week's meeting that whether GDP growth is slightly negative or slightly positive will not impact monetary policy, next week's employment report for September on Tuesday and the inflation data on Wednesday, the inflation data for October, may prove more determinant in shaping expectations about the Bank of England's future plans. And in my opinion, the CPIs may play an even bigger role. Now, according to the UK PMIs for the month of October, price-charged inflation accelerated to a 3-month high. And this tilts the risks surrounding the CPI report to the upside. As for the wages, the KPMG and REC UK report on jobs pointed to a further easing on overall pay growth, which could mean a small slowdown in wages for the month of September. Now, having said all that, even if the economic activity contracts somewhat and wages slow a bit, they will slow from the very high rate of 7.8%. And even if that's the case, a rebound in the CPI rates, both the headline and core rates, may be enough to prompt market participants to lift their Bank of England implied rate path.
So given all this, what reaction are we likely to see in the pound?
In the case I already mentioned, where we get a fractional contraction in GDP and a small slowdown in wages, but a rebound in inflation, the pound is likely to gain, as investors may start considering the case of another hike by the Bank of England. And even if they don't, they could very well scale back a decent amount of basis points worth of rate reductions for next year. This blend could allow cable to rebound and soon break above its 200-day moving average. Now, on the other hand, further slowdown in inflation or a larger than expected contraction revealed by the GDP data could work against the British currency, as this will confirm investors' view that no more hikes are warranted and that a series of rate cuts may start sooner than previously anticipated.
Haralambos, thanks so much. This was a preview video here at xm.com.